Banks dump everything, head to failure, silver demand to soar. Banks are on the brink of failure, and their situation is going to get worse. These banks are not the only ones running low on cash. Corporations, consumers, this should not be a surprise people are running out of money. Let's start. Goldman Sachs put out a release showing the commercial real estate crisis that has been brewing is picking up steam, and Goldman Sachs tells us there is $4.7 trillion in outstanding commercial multifamily mortgages. That is according to the Mortgage Bankers Association 2023 Commercial Real Estate Survey of Loan Maturity Volumes. The struggle with small and regional banks regarding these loans is that the federal funds rates have been raised, while the short-term rates have also been driven up. These banks are stuck in a place where they're suffering through unrealized losses. They're struggling with treasury securities and mortgage-backed securities, and most importantly, their loan portfolios. The real frightening part is that many mortgages are expected to mature in 2024. These coming months, this is when it's all coming to a head. And 920, this is according to Goldman Sachs, $929 billion of commercial real estate mortgages are expected to mature. About 20% of that $4.7 trillion in total. Commercial mortgage outstanding they will mature in terms of property type. They'll mature like multifamily. Office accounts are around 27% and 22% of commercial mortgage maturity in 2024. These are up to mature, and that will hit harder than we ever expected. This is the type of thing that has been pushed off. We here in our community of silver stackers, we have been looking at this and truly biting our nails because we knew it was coming. But this seems to be something that has been pushed off, and now it's just coming to fruition. Now listen close to this part in terms of lender types. Banks hold 47% of debt maturing in 2024. 47% of debt that's maturing in 2024. And that is followed by commercial mortgages at 25%. A large amount of that debt is held in these small size and regional banks. For the past year, we've extended these loans for as long as possible, and now they're all coming to mature. We're in an exceptionally difficult time because rates are still high, and it is likely the Fed will hold on any movement for rates. That's not going to be a surprise. Look, this is an article by Tyler Durson saying $1 trillion in 2024 commercial real estate maturity could lead to hundreds of banks failing. The article states policymakers calling the roughly $1 trillion of commercial real estate debt coming due this year manageable. We've heard that term. We've heard that thrown around, manageable. And they may regret, as Bloomberg Market Live reporter and strategist James Crombie details this. He says the pessimistic prediction is a massive impact on markets and the economy, and it will be tumultuous. We've been hearing for months in mainstream media as political elites tell us everything's manageable. Everything's manageable. Don't think about it. Go back to sleep. But this is all coming to a head now, and we have seen this coming. This is why we stack silver. This is why I continue to be bullish on silver, because as this comes to hit and everything shakes down from it, we're going to see that really the smartest thing to do, I'm just taking out some silver rounds to show, the smartest thing to do is to swap this fiat currency that we have, swap it out for silver. Not necessarily fancy, look, this is like a killer, I think this is actually a 2-ounce round. It might even be a 1-ounce round. It's just so thick. It's so thick, it looks like a 2-ounce round. It's just a koala that I got. I love this. So I'm not talking about this high-end, silver with a premium, but silver rounds. Like this is the smart, this is real money. This is a smart thing to do. So just at a point when now where these banks need cash, the Fed has cut off the bank term funding program. That happened in the past week or two. Like that's been cut. The rug has been pulled out from these regional banks. That was put in place back when Silicon Valley first came down. That was the support system that was put in place for regional banks, and now that's out. So leaving these regional banks, they have to fend for themselves now. This we could be looking at a credit freeze. We'll be looking at people unable to spend money. People will be unable to use credit cards. The credit card issue is already skyrocketing and skyrocketing all across this country. And this article continues by saying that banks are frantically trying to offload that debt, selling at a steep discount to opportunistic buyers like Fortress Investment Group and Marathon Asset Management. The CEO and chairman of Marathon, Bruce Richards, says hundreds of small regional banks could fail. That's what he says. Hundreds, the word was hundreds of small regional banks could fail if default accelerates. A bank run of that magnitude would have significant implications for regulators and policymakers, says a National Bureau of Economic Research analyst in a recent commercial real estate distress study. So when we hear that word, hundreds of regional banks, it is so alarming. It really is shocking. Now, we've heard many say that the soft landings happened. We still hear this to this day. Soft landings happen, but it may truly be that the stock market is giving us a false signal. This just might be a false signal as loans come to maturity. This article states that the delinquency rate for loans backed by offices jumped to 6.5% at the end of December from 5.1% 3 months earlier, according to the MBA Sheriff Office loans that are distressed at these numbers from February. It says the highest in at least 18 months. This is according to Real Estate and Analytics Credit IQ, right? The highest in 18 months. So to say that this is the highest in 18 months shows that the soft landing idea is something we need to look at with a critical lens. And that one thing that I feel comes with the whole idea of stacking silver, the whole idea of swapping out our fiat currency for metals, whether it's gold or silver, whatever you're stacking, is what comes with that is looking at this economy through a critical lens, not just accepting what is given to us in mainstream media, not just accepting what is told for us to lull us into being compliant and calm. I feel that we as a community, we look at all of this as a critical lens, and we see that the smart thing to do is to go in on silver and go in on gold and know that it's a long haul. As gold bumped up past couple of weeks and we got that nice $200 jump, many people are cashing out. And I am absolutely confident in saying that this is not a time that you cash out. This is a time that you hold, even as silver is going to raise with gold. Historically, silver always goes up with gold, and it will be no different now. This is the time that you hold on to your metals, you hold on to your silver, you hold on to it. You have a smile on your face, you're happy that spot price is going up and the value is going up, but you do not cash out just because you see an increase in spot value. This is the whole point of stacking silver, because as we see with this issue in commercial real estate and everything maturing, these regional banks coming down, this is really going to be a huge shaking, a ground shaking moment in the next in 2024 and early 2025 as all of this comes to maturity. So I say, again, I'm not a financial advisor. I'm just a regular guy stacking silver. I say I go all in on silver. I go when I can afford it. I go in on gold because I want to have that security. And I don't want to be one of these people that we've seen lately. A lot of people pulling from 401ks, pulling out of 401ks so that they could pay their mortgage, right? I mean, this is like monthly bills that people are struggling with, and they're pulling in desperation from their 401k. I don't want to be that guy. So luckily for me, I could say that I've been stacking for a very long time, and I have a nice stack of my wealth in metals that nobody's going to charge me if I want to cash out. I do it on my own. Now, The key to a debt-based society, I mean, that's really what we're living in, is this debt-based society. The key to a debt-based society, like the one we have here in the States, is that new loans are taken out to pay off old loans. And this is what really is a struggle for these regional banks. They cannot put out new loans. This happens every day now. When banks begin to tighten lending standards, that when they tighten that and everything constricts with the creation of debt, and it slows down the amount of new loans that are being generated. So over time, with a lag in delinquency rates start to go up, and the financial system is constricted on the amount of money that it needs to pay all this debt and support growth. It's how is it possible to support growth when regional banks cannot do what they do, which is offer loans so the economy can grow? New money is created when banks originate loans. That's how the banking system works. I'll say that again. New money is created when banks originate loans, and that's how this is supposed to work. But as we're seeing, these smaller regional banks are unable to offer new loans because they're tightening and struggling with these loans that are coming to maturity. And yet Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen, they sound sanguine, possibly because there seems to be ample demand for risks that would absorb any shock, in capital markets are just so buoyant. The belief is that only the smallest banks are in jeopardy. That's what we're being told. That doesn't follow through with these numbers, right? These numbers seem much stronger than that. And this article states that weak companies that rely on bank funding will suffer directly if lending standards tighten, and also if a spike in commercial real estate of real estate defaults pushes up funding costs across the board. Now, the article says, in addition, trouble is not confined to the U.S. It says Germany, Sweden, Austria, and South Korea are other countries of concern. Just as Citi's Chuck Prince probably rused the day he told FT he was still dancing back in 2007, right? Nobody wants to be that guy saying, oh, we're still dancing and everything's crashing. And that was right before subprime erupted, and policymakers were likely rolling their eyes. Now, here's another article. This article states, wages in the U.S. are falling at a striking pace. This is according to Indeed. And it says, based on salaries for job advertisements listed on Indeed, it shows that salaries were up 3.3% in February compared with the same time a year ago. That is a market drop, though, from January 2022, when wages were up 9.3%. That is a serious drop from 3.3% to 9.3%, suggesting that employers are facing less competition for new hires. The pace of deceleration is striking, this article says. This is according to Indeed labor economist Nick Bunker. He says, posted wage growth has fallen by almost 3% points over the past year. Now, all of this data, all of this shows us that what's coming, what's looking ahead for us in 2024 and early 2025 is that these loans are going to mature. Commercial real estate, it doesn't look like much change is going on in terms of hybrid work and these empty office spaces, these commercial buildings that are not filling up again since the pandemic. So as all of this comes down, I continue absolutely to be bullish on silver, and I say it is clearly the smart thing to do.